Good evening, everyone. Welcome to New Covenant Worship Center. We are here live in the building for our free home buyer seminar, and we are grateful and excited for you guys who have joined us online. Those of you all who are in the building, it's going to be an awesome informational session tonight. We got a great team of financial wizards in the building. They got knowledge, they got wisdom, they got all the things and the tools that we need in order to put us in a position to buy, to sell, to invest. We're going to get all that information here tonight. We got insurance people here for your homeowner's insurance. So we have everything that's necessary in order for you to put you in a position to prosper and to find yourself to be in a position to buy, purchase, sale, whatever you're looking for. We have the answers here tonight. So I'm thankful for my brother. I'm telling you, he's an awesome man of God. Michael Hallman, he got this together for us, and he's an awesome realtor with Carmack Realty. And so I'm just going to introduce the team, and then Michael's going to come up. So we're going to have Michael Hallman from Carmack Realty. He's going to come up. We got Michael Chance here. He's the mortgage consultant from Key Financial Sources. We have Brian Phillips here from Property Casual Insurance, and we have Eva here from Key Financial. So you guys are going to have an awesome time. After they present, we're going to have question and answer, so you guys can be open to ask any questions that you may have, and we'll try to get those things answered accordingly. So if you all can just give a hand for this brother here, Michael Hallman, as he comes forward, and he's going to open up tonight. Anyone you want.
Good evening. Good evening. Thank you all for coming out. First of all, thank the man of God and New Covenant Worship Center for inviting us out, for allowing us this opportunity to share with you guys some information. Again, this is for information. We're here to share knowledge so that you, again, are in a better position to have some questions answered if you're interested in buying, if you're interested in selling, if you're looking at some investment properties. We're here to share information. If this results in you doing some business with me, with Key Financial Sources, or with Brian Phillips, then that's just a bonus. But we're here to offer information. And again, after we're done, if you have any questions, we're here to answer them. We do have some index cards and some pens up here. If you decide you want to come and grab an index card and a pen, if you want to write down your questions, feel free to do that as well. So we're going to start with the bullet points. We started with the first question: do you need a realtor? It is pronounced realtor, not realtor. Do you need a realtor? Yes, you need a realtor because a realtor represents your best interest. A realtor, the difference between a realtor and a real estate agent, a realtor works with the National Association of Realtors. So we adhere to a code of ethics that puts you, the client, above me, meaning I can't put my commission above your needs. I'm here to represent you in an ethical way and make sure that your best interest is protected. So definitely you need a realtor to protect your interest. The realtor knows the market. When we talk about the market, we talk about being in the seller's market, being in a stable market, or being in the buyer's market. The real estate your realtor knows the neighborhoods. The realtor, if he's here in Illinois, he or she is here in Illinois, they know the different neighborhoods. They know the school districts. It's their job to know the things that they're going to benefit you as a buyer in those areas. So when you talk about being a realtor and you talk about representing your clients, the first thing that you have to talk about is what drives the real estate market is two things: the supply and the demand. In order for you to be in a seller's market, you have less houses for sale and you have more buyers. If you have 5 houses for sale and you have 100 people trying to buy those 5 houses, you're in the seller's market because the sellers have the control. I, as your buyer's agent, I have to come up with ways to get your offer accepted. When you're in the seller's market, it drives the prices up because 9 times out of 10, if that house is 200,000, we may end up offering 210,000, 215,000, just in order to get your offer accepted. Once that offer is accepted, then the ball starts to roll. You have to do an inspection. You go in and you do the inspection, that's your time to walk away from that house. If anything comes up in that inspection that you're not happy with, you can say, I'm done. I can walk away. After that inspection is done, then your lender has to send you to an underwriter. You have to go through the process. They're gonna ask for some more documents, some more check stubs, some more information to make sure that they have everything that they need to be comfortable with loaning you $200,000, $210,000. After they get that done, at some point it has to be an appraisal. So when you're in the seller's market, you may offer more money for that house, but sometimes that house may not appraise for $200,000. So the seller may say, "Are you willing to? If this house appraises for 175, and I'm asking 200, are you willing to come out your pocket with another 25,000?" Those are the things that the buyer has to do in order to get that house if you really want it. My job as your agent is to say, how bad do you really want the house? Do you want this house bad enough to offer another 20,000? But when you're offering another 20,000, you have to realize that 20,000 is another $20,000 in that seller's pocket. To you, that's $20,000 over 30 years. So your mortgage may go from $1,000 a month to $1,200 a month. So it's not really a big deal to you as a buyer because it's over 30 years. But to the seller, that's another $20,000 in their pocket. So you definitely want to make sure that you understand the dynamics of making an offer that's more than what they're asking for. So that's a seller's market. When it's a buyer's market, now you got 100 houses, but you got more houses. You got 100 houses, but you only have 5 people looking to buy. So now the tables turn. Now that seller has to do things to make you more interested in their property. So now they may have to come down on the price. Well, when it was a seller's market, you may have to offer them more. But now because it's more houses and less buyers, and we're in the seller's market, we're in the buyer's market, so now that seller may have to come down on the price. That seller may have to offer you some concessions, meaning when you come to closing, you're going to have to bring at least 3.5, 4% for your down payment. But what you have to realize as well, there's also a closing cost. If your down payment is 3.5%, that closing cost can be between 3 and another 5%. So in a $200,000 house, if your 3.5 down payment is $7,000, that's just your down payment. If your closing cost is another another 5%, now you're looking at another $10,000 for your closing costs. So you're looking at bringing about $17,000 to the table. So when we're in the buyer's market, now the seller may have to say, well, you know what, I'll pay your closing costs. So now you have to bring is your down payment. So that's the difference in what the market looks like and how it affects you as a buyer or as a seller. So that was the thing. So do you need a realtor? Definitely you need a realtor to represent your best interest. What about what's available in your price range? When you talk about what's available in your price range, if you have a couple of different areas that you're looking in, say if you live in Joliet, you say, I want to be in either Joliet, Romeoville, Bolingbrook. It's my job as your agent, your realtor, to look in those markets, look in Bolingbrook, Joliet, Romeoville, and then I'm going to say your money is going to go further in Romeoville because I can look at the trends. I can tell you between 2020 and 2021, the houses in Romeoville only went up 3.5%, but the houses in Joliet went up 5.8%. So that's where I'm going to be able to say, well, your money is probably going to go further over here than over there. So we look at a 3-bedroom, 2-bath house in Joliet, and right now you can say that the average house in Joliet, give me 1 minute. So I pulled up some data from InfoSparks. 3-bedroom, 2 house. From 2020 in Joliet, the average 3-bedroom, 2-bath house sold for $220,000 in 2020. In 2021, that same house went up from $220,000 to $255,000. It went up 15.9%. When we look at Plainfield, I put in Joliet, Plainfield, Romeoville, and Bolingbrook. So right now, Plainfield is the highest. A 3-bedroom, 2-bath house in Plainfield is going to run you $295,000. Last year, that same house would have cost you $249,000. So that's a big difference. So again, being with an experienced realtor, those are the things that he's going to be able to tell you. What those markets are looking like, how much the price increase. Then we're going to look at how long those houses are sitting on the market. I can look in Romeoville and say an average 3-bedroom, 2-bath is sitting on the market 30 days. or maybe sitting on a house on the market 5 days. And I can tell you right now, in the seller's market, they're not sitting on the market long. But if I run across a house that's been on the market for 30 days in a seller's market, that's going to be a red flag. Your realtor is going to be the one that has to give you that information and say, this house has been on the market for 30 days. I need to know why. So that's just some of the things that you're going to have to look at and, again, have an experienced realtor to answer those questions. The next bullet point that we had was, what if you're in a lease? If I'm in a lease and I decide that I want to break that lease and get into a home, and I do that, yeah, you can. It may cost you. My suggestion would be to plan. If you're leasing a home, the first thing you need to do is try to plan purchasing that house a year or two in advance. So when you can start saving up your down payment and saving up for that closing costs. So if you're going to do that a year or two in advance, you can kind of plan to start looking, getting your pre-approval first, and then start looking maybe 3 months before your lease is up. If it takes you longer than 3 months, you can always go to a month-to-month lease, which is something I had to do. I had to go into a month-to-month lease because I ended up buying a new build. That's another thing that you can do in this competitive market. If you feel like you don't want to go and pay $10,000, $15,000, $20,000 over asking price for a house, or if you don't want to go through all of the competition that you have to go through right now so far as bidding on a house and having your offer not accepted and going through that over and over again, you can always say, I'm just going to go do new build. And that way you don't have to worry about your offer not being accepted. You just start from the ground up. Some new builds are already done. Sometimes they may have what they call the house that they show, that they're using for just showing the property, and then when all the rest of the houses are sold, they sell that one cheaper. So that's something that you can always look at. But if you're in a lease, most leases do have a new home buyer's clause in it. You have to read your lease. Most of them do have it where if you buy a house, they will let you out of the lease, but sometimes it depends, again, on the market. If they know that they can rent that house again right away, they may let you out. Sometimes what they'll do is if you still have 5 months on their lease, they'll try to make you pay that 5 months and let you out and not put anything negative on your credit report. So that's always very important, and that goes back to what kind of relationship you have with your landlord, in a sense. But it's definitely something that you can do. You can definitely get out of a lease if you are in a lease and you decide to buy a house. But again, I would definitely, if you're planning to buy a house, you want to start that process early. You want to start a year or two. You want to say, okay, if it's 2021 now, I'm looking to buy next year, unless you just have $20,000 to put down on a house. If you need to save for that, then you want to start a year or two in advance planning for that so that you can make sure that you have that down payment and that closing costs in your bank account before you even start going to shop for a loan officer or a lender, because that's what you're going to need. So with that being said, the last bullet point that we had is, how do I get started? Again, how do you get started? You start saving. After you start saving, you find you a good realtor. Usually, myself, I have a list of lenders, attorneys, and inspectors. Mike Chance from Key Financial Sources is one of the best lenders that I've worked with. That lender needs to get you from pre-approval to closing in an easy, flawless manner. That lender has to communicate with the real estate agent, the attorneys, and with sometimes with other entities in the real estate business in order to get that loan closed. That's the key. Once you get that offer accepted, now we have to get from pre-approval to closing. And you want to have a lender that is going to get that job done. And I can tell you that Mike Chance is that lender. So at this time, we're going to bring up Mike Chance, and Mike Chance is going to introduce Eva, who is going to talk to you guys about the lending process.
Hi, all. Thanks for having us out here, and I just wanted to go over a few things. As Mike said, I am with Key Financial. We are a mortgage broker, been around for about 20 years. I'm now the senior loan consultant over there, so more so than anything else, I'm here to answer any questions that you guys have. Um, Buying a house is going to be probably one of the biggest investments that you guys are ever going to make, or that most people are ever going to make in their lifetime. So it's very important that you have a lender that's going to help you out, a realtor that's going to help you out, and other people that are all involved that are going to make the process easy and, work for you guys and some make the process enjoyable. That being said, sorry, I'm a mortgage person. I sit behind a desk, not talking to people. So, but your loan officer, you want to be comfortable with your loan officer, because our job is to get you from pre-approval through application to closing. We want to get that done as smooth as possible, make everything as easy as possible. Like I said, to make things enjoyable. The home buying process should be a fun process. You should be excited to buy a house. The last thing that you want to do is go through this and have it be a nightmare and all that. So, that being said, I'm going to bring Eva up, and Eva's going to go over a bunch of bullet points and give you guys some information. And then if you guys have any other questions, just feel free to ask away. Thank you.
There you go. Thank you, Michael, and Apostle Jonas for inviting us. Key Financial is very excited to be here, and we're excited to be a part of the seminar. Along with us, we also brought Brian Phillips. I'm just going to mention him briefly. He is not part of Key Financial, but he's part of the sister company of Key Financial. So Brian is the director of insurance for ClearPath Financial. So it's all financial here with us. So Brian is also an integral part of this process, and we'll talk about that in a bit. I appreciate the template that Mike put together in terms of some topics that we should go over. The home buying process and pre-approval process is complex, just to say the least, and it's intimidating, but that's why we're here, to kind of help answer any questions you may have. I think we're going to go through Q&A after, but the first bullet point goes over, how much can I afford? That's a great question. Everybody's limits can be different, and there are many factors that go into determining how much you can afford. And it starts with your income, your assets, and your credit. So again, there's some handouts that have specifics on that, but we have a formula, we have calculations that we put into our system that help us determine, once we run your credit, figure out your income and so forth, what you can qualify for. Generally, the rule is 45% of your gross income. You don't want to exceed that in order to be approved. But again, many factors go into that. Item number 2 on the list is, what if I don't have perfect credit? Great question. Not everybody has perfect credit. And what is perfect credit? I mean, the lenders look at credit scores, and that kind of is the driving factor for interest rates. But perfect credit in the lender's eyes, I would say, is a 760 or higher, right, Mike?
Yeah, that's correct.
But that doesn't mean if you don't have a 760, you won't get approved. So that ties into being, it's important to get pre-approved or kind of figure out, is that not working? Yeah. Okay. I thought I was loud enough. So it is important to get pre-approved and start with running your credit and seeing what you're dealing with. A lot of people focus on Credit Karma or use some of those credit systems to kind of gauge where they're at. I've seen clients think that, or run their credit score, and they have a higher score than they actually do. When we pull the tri-merge, because we pull 3 bureaus. Now, I don't want to go down the rabbit hole, but we have to pull the TransUnion report, the Equifax, and the Experian report. And the lenders look at all 3 credit scores, and they take the middle when, considering, and when we're pricing out rates and so forth. So if you want to know what your credit's like and get a good glimpse of where you kind of stand, we can help you with that also. We could take a look at your credit and see, and give you some tips on how to improve it and so forth, if needed. And, all right, and then again, we do have a handout on the table that kind of talks about credit score and so forth, and things not to do when trying to apply for a mortgage, when looking to purchase a home and so forth. All right, the next item is, what will my monthly payment be? Well, that's kind of an open-ended question. It could be anything. Depends, again, on the same factors that we mentioned earlier. How much you're putting down, obviously, well, actually, what your purchase price is, how much you're putting down, do you have PMI, how much your homeowner's insurance will be, because you need homeowner's insurance when you're purchasing a home, or if you're purchasing a condo, you'll still need like a small policy. So there are many components that go into that.
What is PMI?
PMI, private mortgage insurance. That's interesting. So anytime you put down less than 20%, you'll be required to pay PMI. It's private mortgage insurance. And that is calculated based on how much you're putting down and your credit score. So, and we can figure that out for you also during the pre-approval process. All right, and the last item, how do you get pre-approved, or how do you get approved? Well, you call Mike or you call me, and then we'll get you started. A good rule of thumb is, Mr. Hallman had a good recommendation, start saving money, but there are low down payment programs for buyers. But we don't want to go over all of them today. Once we take a look at everything, we kind of evaluate and analyze where you're at, we could tell you what you'll qualify for. But we will need income, so we'll need a month of a month of income, so 4 pay stubs, 2 pay stubs, depending on how you get paid. We'll need W-2s, sometimes tax returns, depending on whether you're self-employed or not. And then, what else do we need? We need everything. We ask for blood. I probably shouldn't say that. But anyway, we need bank statements supporting your source of down payment and so forth. And sometimes the process does get grueling, but as Mike said, I think the important thing is to develop a good relationship with the person you're working with, because our goal is to help you get into that dream home that Mike will find you, and make the process from start to finish seamless. There sometimes are bumps in the road. It's never perfect, but we're there to kind of soften the blow. And that's it. And that being said, as I mentioned previously, we also brought along Brian Phillips, who heads up the property casualty side of our business. And he is an integral part of the home buying process too, because you will be required to have a full year of homeowners insurance paid, and a monthly, you'll have to have homeowners insurance, and you'll have that as part of your monthly bill. So that's it. Anybody, anything else? No? We'll take questions after.
Hello, thank you, Eva. Thank you very much, Apostle Jonas, for having us, and Michael for inviting us along. As Eva said, I am the Director of Insurance at ClearPath Insurance, ClearPath Financial Insurance. We are basically have 4 different business lines. So we do insurance, we do the mortgage side, as well as tax and planning as well for financial planning. I spent about 5 years with State Farm as an independent agency owner, captive with State Farm, and recently left for ClearPath. I'm now what they call an independent agent. So the difference basically being is when I was with State Farm, I sold only State Farm products and was able to help you out and educate you on that. But now I'm able to, our company is able to offer multiple products. So basically when you're one of the, kind of piggybacking on what Michael said, education is what I believe is the most important thing in insurance, in real estate, and in mortgage. So having that team, like Michael said, having a realtor who is knowledgeable, not just being knowledgeable, but being able to share that knowledge with you and educate you on the process and the steps to make. Same thing with Mike. Mike actually refinanced my house for me this year. I was coming off of being a business owner last year, so I had a little bit of complications with it was just not clear, cut and dry. And he was able to walk me through that process. So I can firsthand say that having someone who can kind of explain that to you, and I know this last year he's been working 12, 15-hour days because it's just been that busy. So he's a great resource. Eva's a great resource. You know, really getting the knowledge of what you need is most important up front, especially with the credit score, the money needed for a down payment. If you don't know that now, you might not be sure what you're planning for the next 2 years, right? You know, while you're saving that money, you could also be maybe, hey, I want to get my credit score up 30 or 40 points by a year and a half from now so that my interest rate might be a little bit lower. Where I come in on the insurance side, if you already have an insurance company, generally when you buy a house and you add that policy, you're going to save about 35% on your homeowner's policy if your car and home are with the same provider. So obviously I'm always happy to help you. Let's say you have a policy with American Family for your car and your renter's policy. Really the time frame in order to get a quote and be able to provide it for your mortgage company once you've put an offer in on a house, they can usually get that done for you in a day or two. So that's really not something you have to go out every time you look at a house, say, hey, can you run a quote on this house? Once you put an offer in on a house, reach out to your agent, reach out to us. We can always shop all of your auto, your home at that point. Part of the process is us providing a declarations page to the mortgage company. That's part of them being able to approve you for a house. The way it works is your annual premium, anytime you buy a new house, you are required to pay 1 year of insurance. So let's say you buy a nice new house, your annual premium is $850. The mortgage company requires, actually it's the state, right? Lender, they require you to have that insurance for the first year before they're going to go ahead and give you the money for that house. So that usually gets rolled into either where you pay that up front with us or that'll get rolled into your closing costs. So give us a call, give your agent a call, and really that needs to happen a few days before, you know, really that you're saying, hey, I need.
About a week before closing or so.
Yeah.
At the very latest.
Yeah, so again, making it seamless, educating you. When you do that though, there are different endorsements, different types of policies you can have on a home. Make sure that you have an agent that's explaining what your coverages mean to you. There's nothing worse, and you know, sometimes people learn the hard way where there may be a coverage that's not included on a basic policy and you have no idea about that until you need it. So make sure that that agent walks through that quote with you. Make sure they explain what those coverages mean to you. If you have trust in your agent, and that's a great agent there, I deal with lots of friends, lots of family who have other insurance agents. So I'm not trying to get the business. I'm just saying make sure, though, that they take the time to explain that because, like Mike said, this is probably the biggest investment you'll make in your life, you know, until maybe you buy another house. But make sure you have a team, you know, whether it be Mike, Eva, myself, or some other trusted people. Just, you know, we really want to educate you guys and help you any way we can. So.
I have one more thing.
Oh, sure.
I forgot to mention, Brian brought it up as he was talking about the insurance brokerage piece. Key Financial is also a is a mortgage broker. So I don't know if Mike mentioned that from our team. We work with a number of lenders. So it's not like walking into Chase or Bank of America. If you don't fit their model, you may not get qualified with them. We have options. I'm not saying we could do everything, but we can do a lot. And we will find the loan and tailor it to fit your needs and your credit and your income and so forth. So we can shop around. And that's the nice thing about both of our businesses from an insurance and a financial perspective. So we have options. We're not limited. You know, and then that does help us, and it does allow us to shop the best rate for clients also. So just thought that'd be an important piece to cover. Thank you. All right, anyone else? Thank you.
Awesome. Y'all can give it up for them. They've been doing an awesome job tonight. This is great information. So this is the part where you guys can interact and you guys can have your questions that you probably have, you know, made note in your phone, you made note in your notepad or whatever you may have. And I'll have Michael Hallman. He'll come up, and whatever questions that you have geared toward the realtor, and then if there's any financial questions, then you guys can just grab a mic and stand up and just pop in there and answer those questions as they come. But don't be shy to ask your question. No question is crazy or whatever the case may be. Please get the information while you have these very knowledgeable people here so that they can assist you and get you going in the right direction. Because this is an opportunity where you can actually move into that next level and get to that place where you desire. And they've already given you kind of a heads up. Start planning 1 to 2 years, whatever your situation may be, in order to put yourself in that position to be able to move forward. So it's not too late and it's not too early. So the thing is to get the information now and, get the ball rolling and whatever you may need. So the floor is open for questions. If you have a question, just please raise your hand. Deacon Ryan will grab you a mic because we definitely want to be able to hear your question and get you going. He's the first one with a question. Now, we got to have a mic so we can...
Before you start this process, what should your credit score be? If you have some credit challenges, what should be working toward to get your credit score before you can get that loan?
You're looking at credit scores, depending on what kind of loan you're trying to get approved for. We can do loans for FHA loans down to, say, a 500 credit score, depending on how much money you want to put down. Maybe if you have a lower credit score, you have to put more money down. On a conventional loan, you're looking for a minimum credit score of a 620. If you don't have a 620, you cannot get a conventional loan. If you have any military history, a fantastic loan out there is a VA loan. VA loans are by far my favorite loans because you can buy houses with no money down. You get a fantastic interest rate. You have no mortgage insurance or anything like that you have to pay, and it's just really a great rate. But it just depends on your personal situation and what your score is as to what we can or can't do for you guys.
So your suggestion is like a 600 or so, over 650?
Again, right now you can be as low as 580. If you're talking about conventional, what'd you say up to?
Conventionals are 620, but even on like an FHA, it's not only 580. Depending on your situation, we can go all the way down to 500.
Right. And I just wanted to jump in on that. That conventional in FHA definitely plays a part in you putting the offer in on the house. Most sellers, if they see a FHA and they have a conventional, they're going to take their conventional. Why? Because the FHA is a government loan, and the government tells you, it dictates to you what criteria you have to meet before they give you that money. With a conventional, they don't have so many restrictions on things you have to do. They're just going to give you the money. So, again, with it being in the seller's market right now, a conventional loan over FHA, 9 times out of 10 is going to win out every time.
And just to piggyback on that too, I think a lot of the issue with an FHA loan as opposed to a conventional loan is I think a lot of the sellers and sellers agents just need to be educated because FHA loans are a fantastic loan. They definitely serve their purpose, but a lot of people have a lot of misconceptions about an FHA loan that the person that's applying for an FHA loan, they don't really qualify or they can barely qualify or their credit has to be terrible or their income is terrible or something like that. But, like I said, that's truly not the case. A lot of times an FHA loan is the right way to go. There's just a lot of restrictions or more restrictions on an FHA loan that was going to cause an issue to sellers. But I think if a lot of the sellers and realtors, depending on who they are, if they don't really know too much about FHA, if they got educated on FHA a little bit, I think they would see that it's a pretty decent loan too. But in this market, like Mike said, it's just you try to put an offer on, on a house and on an FHA loan, and it's just like, I don't want that one. I'm going to take the next one. So.
Can you give us some similar information about multi-units? If you want to purchase a multi-unit, what kind of reserve do you recommend in terms of savings to put down? And can you tell us a little bit about that process?
Are you going to buy it to live in it, or are you going to buy it to rent it?
Yeah, to live in it, to live in one of the units.
Okay, so I don't remember off the guidelines all, but I want to say if you're buying like a 2-unit, I think you have to put, I want to say it's a minimum of 10% down we can do. You probably need reserves of probably 2 months reserves that you need to have left over. after you purchase. And the point of reserves is you don't need to spend that money. And what reserves are is basically if your mortgage payment is $1,500 a month, they're going to want 2 months of reserves or $3,000 left over after all the money is done at closing. You need to have this money left over because they want to make sure if your tenant doesn't pay, if you lose your job, if something happens, you have a little bit of money to fall back on just in case, something like that does come up. The nice thing about multifamilies, though, to help you qualify is even though you have to put a little bit more money down, where you have to put down the 10% or the 15%, the other thing in FHA loan, what I didn't mention is on an FHA multi-unit, and it's by I'm talking 2 to 4 units because anything over 4 units is a commercial loan. But you can do an FHA loan on a 2 to 4 unit, and you're only required to put down 3.5%. And I think you're only required 1 month reserve on that, if I remember correctly.
Another thing with the multi-units, a lot of times the lender will definitely look favorable if you hold that multi-unit for a year or two, and then you decide you want to buy your own house. Now that multi-unit becomes income, and they're going to loan you the money faster when you decide you want to buy that 300,000 square foot house for you and your family and just rent out the multi-unit.
Correct. And the last thing on that, too, is they will allow you to use the appraiser is going to go out there and determine market rent for the units. Whichever unit you're not going to live in, they'll allow you to use 75% of whatever that appraiser determines to be the fair market rental value for that specific unit.
We got 2 in the back.
What if you want to use your 401k? How would that work?
401k for down payment is actually really good and really helpful for you. A lot of people will tell you not to take that money or whatever, but at the same time, when you take money out of a 401k, you can take a loan off your 401k. And if you take a loan off your 401k, any interest that you're repaying back to that 401k is actually getting paid back to yourself. So you're paying interest on it, but who wouldn't want to pay interest to themselves rather than a bank? So it's really not a bad thing. And you would have to look with your employer to see what their terms of withdrawal are, or taking a loan out, or whatever the case may be. Most 401k loans do have some sort of a hardship where first-time home buyer or a bunch of other things are, or not even first-time home buyer, but buying a house is considered one of those hardships where you can take that money if you choose to do so. No, it wouldn't be penalty-free. You're definitely going to pay taxes on that, and then also a penalty if you're not of age. But they did have something recently, ever since COVID came around, where you were able to pull some money out of that. I don't think it was tax-free, but at least penalty-free. But I don't know if that's still going on or not.
In reference to his question earlier,
Bring that mic up to you.
in reference to his question earlier, with dealing with the credit score, will it be wise or to one's advantage to actually go and take a look at their credit history and try to get anything that's been lingering, as they say, for more than 7 years to kick your credit score up? Because those things that are lingering that's just been there stagnant will hinder or bring your credit score down. But if you get it deleted or you do what you need to do to get it cleared off, will that help the credit score?
Most of the time it will, but for example, like collections, let's talk about. If you have a collection and you pay off your collection, it's not really going to change your score in the immediate future. So what happens is you have a collection and then you pay it off. Now you have a paid collection, but you still have a collection on your credit report. But what you can do is, regardless if you paid off in full or if you were to try to negotiate with the collection company, you can, part of the negotiation, you can ask them to remove that collection from your bureau as if it never happened. And a lot of times they will do that. And if you can get that completely erased off your credit report, then that's fantastic. Now, the other thing too is it's kind of hard to say. What I think is, a lot of times I have the ability, you probably don't have the ability yourself. I don't know any credit companies out there that give it to you, but I have credit simulator tools where if I pull your credit, I can go in there and do what's called a what-if simulator, where I can delete accounts like collections, or I can change your balances, or I can do whatever, and the simulator is going to tell me roughly what your score is going to be once all those changes are made. So even though it ends up being a hard pull, sometimes it's worth it. Credit inquiry is maybe going to hurt your credit report a little bit, but if you don't have your credit run often, then one inquiry is really not going to hurt you too bad.
And I have two more simple questions. Are there any incentive? I know for first-time home buyers, it seems to always be a program or something that can bring things down, like a whole point for financing. Are there any incentives out there for a individual that's selling a home and want to repurchase another one? Are there incentives that could help you to get any credits toward or points off?
As far as on the mortgage side, nothing that I can think of. The only thing that they do have is if you're an investor and you're going to buy another investment property of equal or greater value, they have what's called a 1031 exchange account, where you can take your proceeds, put it into the 1031 exchange, and then it basically doesn't help too much because all you're really doing is delaying the inevitable, but you can take your proceeds that you would normally get capital gain tax on or whatever the case may be and roll it into the next one and just basically delay it. But as far as reduced interest rates or things like that, there's nothing that I'm aware of that you can do. But, different cities and things like that do offer some grants. So depending on where you're buying, and I'm sure Mike could probably help you, if you're buying in a certain city, you can do a little research or call the city and just ask them if they have any grants or anything like that you could potentially qualify for as far as down payment or closing costs.
Okay, and my last question is about refinance. And so, because, as everyone know, and you guys said earlier, when you think you find something, by the time you go through everything, someone outbids you, going forward. But if you find yourself in a situation where that you cannot find the home that you desire or at this time because everything is going so quickly, do you suggest, let's say I put off selling my home for another year or 2 years, would it be beneficial to me if I'm in a higher bracket? Let's say I financed years ago at 5% versus the rate at 3.5 or 2.5. Is it advantageous for me to refinance for that year or 2 years, or will that help me at all?
So you were talking about points earlier. So you're familiar with paying points to buy down your interest rate? What a lot of people don't know is that the opposite is true also. You can buy up your interest rate. So regardless of what your rate is, you want to kind of weigh out what rate you can get versus what rate you have, how long you think you're going to stay in that house. And let's say you're going to stay in there for 1 year, and you have a $200,000 loan you're paying 5% on, and you can just get 3% now or something like that. Well, if you save 2% on $200,000, that's like $4,000 you're going to save in 1 year. If I can do a loan at, let's say it's $275 today, and you have to pay closing costs of $2,000, let's call it, you're still going to end up saving money. But maybe what I can do is, instead of giving you $275, maybe I give you 3% or 3 1/8. And instead of you paying points to buy down your rate, the lender will actually give you money for taking a higher interest rate. So now you can take that lender's money and use that to offset the closing costs. And then even if you end up saving $2,000 and you're only there for a year, it didn't cost you anything to do it. So a lot of times it definitely is worth it to refinance, even if it's a short period of time. It just kind of depends on your situation. And, we would, a good loan officer would go through that with you and explain to you exactly how things are going to work.
Yes. Hi, I have a question. I'm kind of looking into buying a home now, but I've actually been looking a lot into building a house, but like a tiny house. I don't know if you guys have deal with those or not, but I was looking probably to buy like a plot of land first, but I just wanted to know, what was your idea or recommendation for going to that route of building a house?
Well, as far as on the financial side, I would tell you I can't help you on that. We don't do those. We can do renovation loans, but we cannot do new constructions. A house would have to have had some sort of an occupancy permit before I can do it. Now, I can, recommend a fantastic bank that does specialize in that stuff and can really help you. But as far as the rest of that, as far as buying a lot, I don't know if Mike has anything to add to that.
I definitely can find you a lot if that's what you're interested in. They definitely have new build. They have large construction companies. They have smaller builders. Usually, right now, what they're building, which is the most popular home, 3-bedroom, 2-bath. You can get something from the ground up with a smaller building and say, I just want 2 bathrooms, 1 bath. It's definitely possible. With the MLS, which is our multi-listed service, I can search for just land in a certain area. All that's possible. So we have cards up here. If you're interested in buying, I have the blue folders. If you're a seller or know someone that may be interested in selling, I have the yellow folder. It's a buyer's guide and a seller's guide. I also have my business cards up here. And you can also scan one of my QR codes to go in and just pull up one of my marketing materials online. So definitely before you leave, come up.
What actually is closing cost?
That's a loaded question. So typically, closing costs are going to be lender fees. For me, lender fees for all my different banks that I work with average somewhere around like $1,100. On top of that, you're going to more than likely have to have an appraisal. You're going to have a credit report. And then depending on where you're buying, like if you're in like Cook, Kane, Peoria, Will, all the big, not really so much Peoria, but Cook, Kane, Will, Lake, DuPage, the biggest part of your closing costs is going to be title insurance fees. The title insurance fees, the seller's attorney is going to choose the title company, and then our side, because I will be with the buyer, is going to be stuck paying whatever fees that particular title company charges. Along with that, depending on what city you buy in, they're going to potentially charge transfer taxes. You're going to have an attorney. That attorney is going to charge whatever they're going to charge. Typically, you're probably looking somewhere between $4,000 to $5,000 in total closing costs, but Mike can a lot of times help you with that when you're putting your offer in to buy a property. And I don't know if you want to go over that.
I can tell you for sure in Will County, the transfer tax will hit you. It's $7 for every 1,000. So if you're buying a $200,000 house, $7 times 200,000, you have to pay the transfer tax in Will County. Now, some other cities, the seller has to pay that transfer tax. I know for sure because I bought in Will County. In Will County, the buyer has to pay that transfer tax. So with that being said, with the closing costs, that's one of the things that you have to look into. What he was saying that I could help you out with, which is what I mentioned earlier, if you're buying a $180,000 house, and I tell the seller, I want you to pay my buyer's closing costs. This is how we do that. Say your closing cost is $5,000. The seller said we'll pay it, but what we're doing is they're really not paying it because now we're going to offer them $185,000 for the house. So basically what you're doing is you're financing your closing costs. You just don't have to come out of pocket with it. So it looks like the seller is paying your closing costs, but actually they're getting their $5,000 back on the price of the house. So basically now all you have to do is bring in your closing costs. All you have to do is bring in your down payment, and you don't have to pay the closing costs. But you're really financing the closing costs.
But, again, if you don't really have the money for the closing costs and you spread it out over a 30-year period, it's doable. Sometimes that's more doable than trying to come up with $5,000 however long it is. So there are different options.
I had a question. Can you talk a little bit about being financed as an elderly person? Like, I think about my mom who wants to sell her home and, downsize to something. But, of course, she's concerned because she's, getting 70. So what do you recommend for that, as you get up in age and trying to take out a mortgage now?
Well, first of all, there's no restrictions. You could be 95 years old and take out a 30-year mortgage. That's just how it works. And everybody knows it's never going to happen, but you can do it. That said, there's different options. You can do what's called a reverse mortgage. They're expensive. But the nice thing about a reverse mortgage is you don't have a mortgage payment. So your reverse mortgage is dependent on your age, and it's depending on the equity that you have in your house. Dependent on that is how much money you can borrow. And the nice thing about a reverse mortgage is when you do a reverse mortgage, you no longer make a mortgage payment every month. So now the bank is actually going to give you a lump sum payout at the closing, or they're going to give you monthly distributions that you can use to pay bills or whatever the case may be. It's basically like a negative equity loan where the interest that you're paying is accruing to the loan. So if you owe $100,000, each month that you have that loan, that interest that you're not paying is accruing into the loan. And then you're going to end up owing more than what you started with, unless you choose to pay principal down. That said, when that person was to pass, then one of two things: either the bank is going to take the house if there's no heirs or anything like that, or the family can take the house and sell the house, and then split the proceeds as they normally would. Other than that, your other option is you can do a 30-year fix, you can do a 15-year fix, you can do basically whatever you want to do, just dependent on your situation. And then I would have to go over your specific situation to be able to figure out exactly what the right move is. So
I can tell you that I had the young lady that sold the house, well, the older lady that sold the house that I sold for her in Roseland. Even though she got $153 for the house, she still owes something on the house. She's basically walked away with almost $90,000. So if she decided to go and buy something, if she's putting down 50 of that 90, and she buying a $100,000 house, she has retirement money coming in. She's okay. Yeah. So that's something to think about as well. If she's gonna sell a house and then buy something, depends on what she gets for that house and how much she's gonna put down. She's safe because she doesn't have a real high mortgage. We had a question over here. I'm sorry, back here.
My question actually was, I know you mentioned earlier because you mentioned about the land, but I would actually look at this home and this guy, they was mentioning like kind of as is, so I know it's going to be like renovations and things that need to be done. I would have liked that, so I was wondering, I was kind of looking into it like that, and I know, so how would that work? So I approach you guys, how would I go about doing that?
So when you want to buy a property and the property needs work, more than likely a bank is not going to finance it unless you're going on a specific program. Fannie Mae has a program called, I want to say it's Home Styles, and FHA has a program called 203K. Those loans, what you can do is you can finance repairs into the house. When you're doing that, more often than not, you're going to need what's called a HUD consultant. They're going to go out there, they're going to see what repairs are required in order to have this house meet HUD requirements. And then you're also going to have a contractor, and that contractor is going to give us a bid on repairs, and that bid on repairs is going to then be used to submit to the appraiser. Okay. This way, when the appraiser goes out there to give you a value of the property, they're giving you a value as completed. So they're going to use these plans and specs or whatever it is from possibly an architect, just a contractor, whoever it is, depending on the work that you're going to do, in order to figure out that value, and then based off that value, then we'll be able to lend you money in order to make those repairs. That money would be held in escrow, so you wouldn't be able to touch that money, but that works in draws. So the contractor would go out there, they would do the first part of what needs to be done, maybe demolition or whatever it is. Then they'll go to the bank and they'll say, okay, we want to get paid for this, and the bank will pay them for it. After that, they'll go there and they'll do maybe the electrical and the plumbing and all that kind of stuff, and then they'll want to get paid, and then the bank will pay them for that. And then finally, when everything is done, they'll draw all the money. You should have the house that you want with everything fixed, and the bank, the contractors has all their money, and then you're going to pay, interest from that's going to turn into a 30-year fix after that, or whatever you decide to do.
And basically, from a real estate standpoint, if I was working with you, actually, Mike and I are working on a 203K loan right now for a friend of mine. So basically what I would do is, if you have a fixer-upper, I'm going to look in that area and see what renovated properties closed for within the last 6 months. So if you're purchasing that house for $80,000, $90,000, and I can see where you're purchasing a 3-bedroom, 2-bath, And I can see where a renovated 3-bedroom, 2-bath closed for 200,000 or 175,000. That's where we want to get it appraised at, and then they'll decide how much they're going to give you to fix it up to get it to that point.
And
203K loan, FHA.
And also his wife Chantel, she's embarrassed to ask a question, but they live in Indiana. So does the rules, the same thing apply in Indiana and Illinois? Is it different?
No, those are going to be, they're governed by the rules that I'm talking about right now are Fannie Mae, Freddie Mac. I don't know if you ever heard of them, but they're like the big secondary market that buys up all these loans from the bank. And then the other one is FHA, and they basically make all the rules that all the banks follow nationwide. The other thing too is within next month or two, we will be licensed in Indiana, and most likely Florida too. So if you need anything in Indiana, Florida, Illinois, we can definitely help you.
Do you all work with NACA? Do you have any interaction with NACA, the neighborhood association? I'm just trying to look for it. What the
I've heard that
acronym
name.
is.
I'm not exactly sure what they do, but definitely heard that name.
Neighborhood Assistance Corporation of America.
So far as your down payment, or
Just wondering if you all have ever worked with them before, if you had any.
I think they assist with your, what do they do? They assist with your
Yeah.
loan, or they assist with your down payment?
Yeah, they were birthed out of a labor organization several years ago, and they used to sue mortgage companies and lenders who had racial practices against low income
Redlining.
and black. Yeah. And so they help folks who think they can't afford homes get assistance.
Okay.
But I know, all I know directly is that they have mortgage companies or realtors who are certified to work with them. So I just wanted to know if
I've heard of them. I have not worked with them, but I can tell you with Mike, one of my buyers that bought a house in the city, her husband and wife, they came to me looking to rent to own. They didn't feel like they could buy a house. Not only did Mike get them approved, he got them approved for conventional. So again, he's a mortgage consultant, so they shop around. So it's not like they have to be tied to certain restrictions that one bank would be tied to. So I was very surprised because actually I had sent them to another lender before sending them to Mike. They couldn't get them approved. So that's somebody that definitely can help you out when your credit may be challenged.
One quick question. I think you had mentioned, can you give us a scenario of a person that purchased a home and with a 500 credit score? I mean, because that seems like unbelievable. Just to kind of, just share the scenario because, how did that happen?
So with FHA, FHA really doesn't have a minimum credit score. It's basically the banks put on what's called overlays, and they say, all right, we're going to go down to X credit score, and that's all we're going to allow. So with a 500 credit score, I had to do a 10% down loan because you couldn't do, normally FHA will allow you to do 3.5% down, but down that credit score that far, the lender required to put 10% down. So we did that. But more so, FHA, it's kind of, they do allow like manual underwriting, and it's a little bit easier to get approved on an FHA. I shouldn't say easier, but there's more forgiveness, I guess, with an FHA loan. So when you're looking at somebody's credit report, you can have, a lot of the purpose of an FHA loan, and a lot of people have probably gone through it, you have perfect credit for all this time. Something happens in your life to cause, your credit score to go down, whether it be an illness, a divorce. I've seen a million reasons why, credit scores have dropped for whatever reasons. But then time has gone by and you've picked up your score again. In those situations where, we can look at it and we can see that credit is better and you've been, let's say your credit was terrible, but you've been making all your payments on time as far as your housing and a few other things. Everything is kind of dependent. It all has to be run through an automated underwriting system, but sometimes it does give the approval, and I do have lenders that go down that low, so it is possible. So it's not often that it's going to happen, but with a 550, the other thing you can do too, if you have a strong co-borrower, like let's say maybe you have a 500 credit score, but you have a co-borrower that has like a 700 credit score, that's definitely going to help you get approved. So.
Okay, I hear credit scores. What about your annual income? Say, for instance, you want to buy a house for $150,000. What would your annual income have to be? And what if your credit score was only 500?
It's really a loaded question. It's going to be very dependent. First of all, what are
You
the
got to come in the office for that one.
Yeah. What are the taxes and insurance on that particular property? How much other debt do you have in your name? But let's say your payment is, I don't know, you just want to stay like at 45% of your income. So let's say you're making $40,000 a year, figure, that's 33 a month. So you figure half of that's about 1,700. So maybe you want to stay around $1,600. You want all your debt, including your housing payment, not to exceed that 45%. And maybe you can, but as a rule of thumb, I don't like to go over 43 to 45%. But the computer's ultimately going to be the boss most of the time. And on an FHA loan, if we get you approved automated and it approves you at a 50% debt ratio, it's fine, you can proceed. If it approves you at a 55% debt ratio, you can proceed. It just depends on, if it's a manual underwrite, you're stuck at like 43 to 47% of your monthly gross income, and it's gross income, not net income, so before taxes and before everything else. So, but it's really a hard question to answer because there's so many other variables that come into it.
And Mike mentioned the taxes. That's also another thing I do when I'm shopping for my buyers. When I was talking earlier about searching in different areas, not only am I looking for the area where your money is going to go the furthest, I'm looking at the taxes as well.
I have a friend that would like to purchase a townhouse. The question is, credit is terrible. So if her credit score is 450, and let's say she wants to put down 80,000, and if the home is only 130 or 150, will that be very helpful for her to put more down? Will that get her in the door?
I mean, it's definitely helpful, but as far as any lender that I know, once I get below 500 credit score, I don't know any avenue to get somebody a loan at that point. The only thing that I can think of is, they do have seller financing if they're going to put that much money down. I don't know if Mike wants to talk to you a little bit about seller financing, but what you can do is you can go into the house and say, all right, seller, maybe not in this market because, the market is so hot right now, but if they're having trouble selling their house, maybe they'll sit there and they'll take the $80,000 and they'll give them a mortgage and they can just pay that person back. You know what I mean? At a certain interest rate, it would be like a private money type deal between the buyer and the seller. But short of that, I really, as far as banks are concerned, I don't have anybody that'll go under a 500 credit score.
Actually, kind of speaking to that, the 203K loan that we're working on right now, the young lady was renting this property for a couple of years. So the seller really wanted her to have the house. So she's willing to work with her to make sure that she is able to purchase the house. And again, Mike was able to get her approved for this 203K loan. So definitely sometimes you can, if the seller is willing to work with you, it's a plus.
And it doesn't have to be for the duration of the money being paid off. It could be like a 2-year loan that the seller gives the buyer or something like that. And in the meantime, that buyer can work to improve their credit and then pay the seller off at a later time, whatever is determined between buyer and seller.
But again, unfortunately, in this market, you're probably not going to find too many sellers that's willing to work with you right now.
In her case, that she was just in the scenario, would it be beneficial to actually remove yourself from being afraid of coming to talk to you and actually sitting down and pulling that hard credit report and finding a way to get her credit score up so that she would be in a position to buy? I mean, is that would you advise that for to try to find out what things you need to do in order to get your credit in position, so you can get to the avenue of purchasing? Is that something that you would?
Yeah, part of my job is not only to pre-approve everybody and give everybody loans, but part of my job is to be real with people and honest with people and tell them the hard answer is no, you can't qualify for a house. But then also to go a little bit beyond that and say, all right, well, here's where the obstacles are, and maybe here's what you can do to overcome those obstacles. And I do have tools that could potentially help at that point as far as credit simulators and things like that. But yeah, that's all part of what we do is to try to help people because, like I said, not everybody's going to qualify. So, but the goal is to help people qualify at some point.
My stepdaughter, she would like to know what's the difference between FHA and conventional, was that it? Okay.
You asked it already.
So a conventional loan is it's a private money loan that's more often than not it's going to be sold in the secondary market to Fannie Mae or Freddie Mac. So what that means is the rules that those banks have to follow as far as underwriting are Fannie Mae and Freddie Mac rules. As far as an FHA loan, then they're going to follow HUD guidelines. And then, a lot of times it's easier to get approved on a FHA loan than it is on a conventional loan, but sometimes it's the other way around too. It just really depends on your situation. Yeah, the FHA is a government loan, correct?
Well, because earlier he mentioned something about sellers not wanting or not preferring. Why wouldn't they?
And again, I mean, as Mike said, FHA is not a bad word. It's a good loan. It's just that if I'm on the seller side and I see a conventional and FHA, I'm letting you know as a realtor, I'm going to tell my seller 9 times out of 10 to go with their conventional. One other thing that happens with an FHA, if I accept their FHA and the house doesn't get approved, I'm stuck with that for, what is it, a year?
No, you're stuck with the appraisal for 6 months if
6
somebody is going to buy it, another FHA borrower.
Okay, so say I'm asking $200,000 for that house, and FHA only appraises that house at $150,000. Now I'm stuck with that appraisal for $150,000 as the seller. That's why 9 times out of 10, the sellers, again, me personally as a real estate agent, I'm going to 9 times out of 10 advise my seller to go with their conventional loan because there's some rules and regulations when you're dealing with the FHA loan because it's government. But again, FHA loan is not a bad word. It's not a bad loan. It's just that this is, when you're working with real estate agents or realtors, it's kind of like 2 quarterbacks. I have to represent you as my buyer in the best way I can. The selling agent has to do the same thing. So it's kind of like it's a match of the minds. Everybody has to do their homework, and I have to represent you and make recommendations to you as my buyer or as my seller that I think is going to put you in the best position to win.
I have a question related to that as well. So if she finds a house that she loves and she wants to go FHA, but they won't do it. So she says, okay, now I want this house, I want to go conventional. Well, how much of her down payment would have to increase if she changes from FHA to conventional? I think that's the biggest thing.
It depends on whether you can get approved for conventional. Mike can speak to that.
Is she approved for the down payment?
Depending
aspect?
on your credit score, FHA could actually be a higher down payment. FHA requires a minimum 3.5% down payment. Conventional, in some cases, you can get away with a 3% down payment. So they're very similar as far as down payment and things like that. Where it differs a lot is on 2 to 4 units. Your down payment is much different on an FHA versus a conventional. So if you're buying a 2 to 4 unit, I want to say off the top of my head, you have to put 10 to 15% down on a conventional loan. Whereas if you're doing an FHA loan and you're buying a 2 to 4 unit and you're going to live in the property, you can still buy that particular property with 3.5% down.
So if they only want conventional, all is not lost. It may not be a big deal for you as long as you qualify.
Honestly, most of the time, if I can put somebody into a conventional loan, usually the payment works out better. Where it doesn't work out better is if you're at, like, let's say the minimum credit score for a conventional loan is 620. The rates you can, in certain situations, you can get certain programs that are going to get you a really good interest rate. But in almost all those situations, your mortgage insurance is going to be ridiculously high in comparison to FHA. So sometimes, if you have a decent credit score and you want to go conventional, a lot of times I'll, give you your options and basically tell you the conventional is a better way to go. But if your credit score is lower, then it's kind of like maybe you want to go to the FHA because it's going to help you out. Or if you're buying a 2 to 4 unit and you want to put the least amount of money down, maybe you want to go FHA. So.
Now, again, with that, I can't say, like I say, 9 times out of 10, if I see an FHA and a conventional, I'm going to go with the conventional. However, on the short sale I just did, we went with an FHA loan because the FHA offered us way more than what the conventional was, and the FHA loan waived the inspection. So at that point, I told my seller, best thing to do is go with the FHA. So again, with an FHA, in my perspective as a realtor, you just have to go a little bit harder. If you feel like if the market is real hot and it's a seller's market, Instead of going 10,000 over, you might want to go 15,000. You may want to waive inspection. Again, if I'm on the buyer side, I'm never going to tell you to waive inspection. That's just me. I'm not going to ever tell you to waive inspection, but sometimes that's what it takes.
Did that help, sweetheart?
With the 203K loan, when you talking about the fixer upper loan? With the FHA.
They said it was like restrictions. You guys said it was different between the two.
So, if there's restrictions on the property, the point of that 203K loan is to get rid of any of those issues. So when the HUD consultant goes out there or the contractor goes out there, they're going to look and see at the very minimum what's needed to get this property brought up to where it'll meet FHA inspections. And then once you do the loan, then that at least that part of the work has to be done, or they just won't let you do that particular loan.
Okay, so that's the restriction. Okay, I was wondering. I didn't know it varies. So it depends on the property.
Yeah.
But then again, on just a regular, if it's not a 203K loan, it's just a regular FHA loan, and I'm taking my buyer there, and I'm looking around, and I see an open light switch, if I see plugs out, if I see handrails loose, I know FHA is going to tell them to fix that. 9 times out of 10, the seller may say, I'm not trying to fix anything, so I'm going to have to relate to my buyer, this may not be the place because the seller doesn't want to fix anything, and FHA is not going to move forward with all these violations or things they have. And it may be kind of minor, but to FHA, they're not going to loan you the money unless it gets fixed.
So then the seller won't. Okay.
Exactly.
I have two right now, two of them. Hand to God. Each house was missing a hand. I have two buyers right now that are purchasing homes, and they're qualified for FHA, and each home is missing a handrail, which is common sense. I mean, everybody needs a handrail. But the peeling paint issue, like they have peeling paint on the exterior of the home, which may not, in one appears, the realtor should have caught it. But anyway, the other one's not so bad, but they have to fix it. The paint has to be scraped and repainted. So it's a lot of work.
So I had another question concerning that. Like, so I know you said something minor like that need to be done. Like, could I like tell the seller like, hey, I know this is gonna be required. If I repair it, then is that something you can like can work out?
That's the thing. So a good realtor, which I'm a good realtor, the short sale I did, it was a lot of stuff wrong with their house. The bathroom ceiling was peeling. That's all they wanted to fix. And my seller was like, they waived inspection. I was selling it as is. I'm not fixing nothing. I'm like, you're not finna stop this sale. I asked my wife. I put on my jeans. I went over there. I scraped that ceiling and I painted it. Took a picture and said, let's go. Let's keep this moving. I went and scraped that ceiling and painted it. So, hey. I mean, but something minor like that with an FHA, just put in paint. Yeah.
Now that's a good realtor right there.
Exactly.
Get his card before you leave out of here. Anybody else got any other questions? Go ahead.
How would you start if you want to look into buying homes or multi-units for investment?
Well, first thing you're going to want to do is get pre-approved. So you would see somebody like me for that, because Mike's got a lot of stuff he's going to do in his life, and maybe he's got things he wants to do on his Saturday or Sunday rather than taking somebody out for a house that's never going to qualify for a loan. So a realtor, for the most part, is always going to want to have you come talk to me or another loan officer, whoever it is, because he wants to have pre-approval to know that he's not wasting his time taking somebody around that can't get a house right now. Once I get the pre-approval to Mike, then he's going to take you out and take it from there.
If you don't have their pre-approval, we window shopping. I don't window shop. And the thing is, with the pre-approval, you have to know how much house you approve for. Yeah. Okay, if he tells me you approve for $200, I'm not taking you to look at a $300,000 house. So that's why it's important to have that pre-approval. It's important to have the pre-approval.
What are the rules on down payments for investments? Aren't they much higher?
They are. First of all, you cannot do an FHA loan as an investment property that is primary residence only. And then as far as conventional loans are concerned, I want to say, I know things changed due to COVID, but I want to say a single family you can do with 20% down, and a 2 to 4 unit you can have to put, I want to say it's 25% down, but I would have to double check that and see. But I think those are pretty accurate.
I'm sorry, I think she had another question.
Yeah.
I did bring a little handout for investment properties, but again, on the realtor side, I would definitely look at where your money is going to go the furthest. You need to look at your return on investment. You need to look at how much you're going to spend to upkeep on that property. You need to have cash in hand in order to maintain the property. So it's a lot of different variables, but we can definitely talk, and I do have a handout for investments. Just to give you some questions. Answer some of your questions maybe. Awesome.
Anybody else got any last questions? We ready to close this out. On the finance side, if someone has a tax lien, will they be able to get finance, or will that have to be cleared up before they can get financing, or what's the criteria for that?
Well, most of the time, if you work it out and go on a payment plan, then you would be able to, as long as you can qualify with that debt for that tax lien on a payment plan. And I forget how many months that you need to, maybe you need to show a 3-month history on a repayment plan. Let's say your payment on with the tax lien is $100 a month. Well, they're going to take that $100 a month and they're going to put that into your debt ratio, so you're going to have to qualify with that additional debt. And then there's going to be a certain minimum amount of time that you're going to be required to prove to them that you've been repaying it in a timely manner, and then you can go ahead and proceed most of the time.
Any other questions? Did Brian or Eva want to have any closing remarks or anything that we may have missed, or any?
I can't think of anything we missed on my end. I just want to thank you for having us, and please use us as a resource if you need anything. So I know that we're all willing to help wherever needed. So happy that we were able to answer some questions, and appreciate you guys having us.
And even if you don't have any questions now, our information's on the table here. Grab a flyer, grab a business card, give us a call. We're more than happy to answer any questions that you might have.
Just like Mike said, please give us a call. Sometimes questions in person are intimidating. Give us a call on the phone, send us an email. Our contact information's here. We're happy to answer any questions you might have, or take a look at everything and give you a complimentary analysis.
Listen, I think they did a phenomenal job. Let's give them a hand clap. Thank you all for coming out tonight. This was absolutely amazing. And I want you guys, listen, do not be intimidated by the process. Do not be intimidated by the process. My sister-in-law is preparing to get ready to close on a home and different things that she's doing. But, the process can be arduous along the way. But don't be intimidated by it when you never make the initial step. So tonight is the initial step.
Exactly.
Take advantage of the resources that they have here. Pick up their cards, their flyer, the folder, the pen, whatever you need, because it may not be today, but in the next year or two or whatever, you're going to be ready and you're going to have things in place. And I believe this is a great team right here. They gave us some great information. They were genuine. I can see their integrity in their business, in their work ethic. And I think that it's going to be an awesome thing. I know some people that Mike Hallman has assisted personally, that are close friends of each other. They just purchased their home, and things have gone well for them. I'm telling you, this is a great opportunity for you to take advantage of this information and for everything to work in your favor. All right? Thank you all, Facebook. We appreciate you guys tonight. Thank you for coming out. Those of you all in the building, we appreciate you all. Thank you for being here. And give it up for the team again. Give them another hand clap. That's all we have for tonight. We got refreshments in the back if you're leaving out. Can we get a picture just of you four together so that we can